Welcome, everybody. My name is Megan Cox, and I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar, Dating the Right Customers, Driving Profitable DDA Growth. Our speakers today are Hank Israel, Managing Director at Curinos, Michael Whalen, Principal Strategic Partnerships at MasterCard, and Dan McCarthy, EVP, Director of Enterprise Payments and Deposit Processing at Busey Bank. If you have questions during the presentation, please type them into the question box in your GoTo webinar control panel. This webinar is being recorded, and we will send the recording and the PowerPoint to you via email post-webinar. Now I'd like to pass it to Hank.
Thank you so much. Welcome today. We thought it would be fun to talk about dating the right customers in the month of love and Valentine's Day. We were a little bit late on the execution of the show, but hopefully everybody will appreciate the data in this context. We've all been together over the last several years talking about deposit acquisition and the challenges that organizations are facing, both large and small. Today, what we wanted to do is talk about why is it getting harder. The new reality is consumers are seeing and working with more institutions than they ever had before. And then the next question is, how do we find the right customers for our organization? And for different organizations, it's a different target as we go through. Is what's the right target for you, given that your institution and where you play? Talking about how we pull those customers through funding and activation, and then finally, what success looks like in the modern playbook. Thank you, Mike and Dan, for joining us. We hope to make this kind of an interactive session as we go, and so we're off to the races. What we're seeing industry-wide lately is that there is a significant increase in the cost of acquisition, and the value of those acquisitions are actually going down because customers are using multiple institutions as we go. So it's costing more to get less at the end of the day. What we're seeing is that there's beginning to be an analytics gap in the industry, both in terms of the volume of data that smaller institutions have, as well as the talent in order to interpret what that means as we go through, and the ability to execute against those insights. And the last insight is that a lot of organizations over the last 10 years have spent a lot of time focused in on acquisition, unit acquisition, which is, traditionally consumer packaged good measurement, because whatever I sell, I get the value for as we go through. So when I sell an iPhone, I know that I'm going to get $200. We all know as bankers that when I sell an account, I get exactly nothing until we get the customer to use it. Dan, I'll turn it over to you. Are these consistent with what you're seeing at Busey?
Yeah, absolutely. It aligns with what we're seeing internally here. So again, the acquisition costs trending up, average balance is going down, and we really need to think about shifting more towards the lifetime value of the deposit rather than just pure volume-based business. That opening value.
Mike, you've been in the industry a long time and talked to a number of institutions as well. Are these consistent with what they're seeing, or are there other trends that you've been hearing about?
I think just the only other trend from a MasterCard perspective is the downward pressure on the debit economics, with an average debit customer on an annual basis pre-Durbin bringing about $100 in interchange revenue. Now today we see that trending at anywhere between $40 or $50. The good news is you see similar penetration and usage of the debit card products for that particular segment, but what's been driven down is the interchange caps coming through for regulated banks within the Durbin regulation that was passed in 2012.
You bring up a good point, and I didn't even talk about overdraft fees with the likes of new entrants like Chime and other players that have taken overdraft off the table, which was another source of income, especially in the mass market as we go through. So it makes it a lot harder to identify those customers as we go.
Hey, before we move on too far, can we just do a quick check from maybe people can put in the chat? Is the video and audio okay on here?
All right.
All right.
Thanks, Phil.
All right. Just before we get too far down the road. All right.
Cool. Thanks. As many of you on the phone know, Curinos fields a study of roughly 15,000 consumers across the U.S., representing all the major DMAs. And what we've started to look at is what's going on in terms of the flow of customers. And what we see on this chart is comparing acquired customers to where they're attriting from. And it's really interesting is if I look at national and fintech players, they're kind of net growers overall. And again, this is on the average for these different types of the different types of institutions. The second piece that we have is really looking at super regionals through direct banks, where we're seeing kind of the inverse of this, where attrition is overtaking acquisition, at least in forms of units of accounts that those institutions are seeing in relationships. We think this is a scary trend, and we're trying to understand what's going on. Obviously, there's something going on. Any thoughts, Mike or Dan, as we go?
Just think we need to understand which segments, and if we can dig in to do some sort of like peer analysis too, I think it would be helpful to understand, what that range is and, which customer segments are actually being, that we're losing there.
Yeah, I think on that point, as we look at some of the market data, we see a lot more targeted prospects and targeted offers being made for particular segments that are typically well aligned with individual activities with the ultimate goal of trying to own the relationship. I think we're at the early days of that with almost a bifurcation of people banking at different places for different reasons.
Well, I think you bring up a really good point, both of you, is that when I think about the fintechs, most of them have become niche players, and they're focused in on a unique segment where they're delivering on the needs of that segment very effectively. The national players are generally playing towards customers that have broad wallets and the like, and they tend to get larger customer relationships as we go through. It's these in-between banks that are kind of in between the strategies there in terms of that, and we'll try to talk about that as we go through, is making sure that you're fishing for the fish that you can catch, and making sure that the bait's right as well as we go in terms of that. But again, we thought this was an interesting statistic nonetheless as we go. Related to that research, we also do a study each year looking at what's the driver of consumers in acquiring a new account. And overwhelmingly, this is looking at traditional brick and mortar accounts on the left-hand side. What you'll see is in 2015, 93% of the new to bank customers were going to network banks. Today, in 2023 and 2024, that number is reduced to 53% as we've advanced this. More importantly, location mattered. We as bankers acquired customers based on where we dropped our branch network, and we assumed that customers would walk in the doors. And that represented roughly 60% of the purchase decision. Today, overwhelmingly, marketing and experience are driving these additional factors as we go through, whether it's having an improved digital experience, which you can see is kind of declining in terms of its importance, as well as ATM share, which is growing slightly in importance for convenience as we go through. In addition to that, what's interesting is as to where branch infrastructure is a fixed cost, marketing is not, and that's where some of the increase in cost in acquiring customers is coming in. You can see on the right-hand side, from 2019 or 2018 to present, we're seeing roughly a doubling in the cost per acquisition. This is on an all-in basis for all acquisition. So it's all channels divided by all acquisition. Obviously, some of the customers you get aren't driven by actually putting any marketing out there. It's just having your branches there. How has this affected some of your decisions, Dan?
Well, I think first off, just looking at how we're spending money, it matters, right? Because this slide clearly reinforces that the ATM and branch shares aren't as effective as what they used to be, and then there is a lot more emphasis on marketing, and I'm even viewing that different here recently. We got to spend some time with MasterCard and kind of walk through some of the things, some of the pieces of our marketing. I'm not a marketer, so to me, I'm just thinking about mailing things and sending advertisements. But again, I think thinking end to end paints the picture a little bit more clear, right? So like how are customers searching for you and finding you, whether it be on the web or via mobile, and then how easy is it to get from there to product, not just what's put into these things. So the slide seems correct in terms of the cost of these things, but I do think that sometimes we're making it probably way too hard for the customer to get from curiosity to product. So it is changing the way we think of it for sure.
I like it.
The one thing that jumps off the page to me here is it's gotten so much more expensive to acquire an account. And I think the importance and one of the reasons why we partnered with Curinos is you've got to make sure you're bringing in quality customers that are generating meaningful revenue to offset those increased in costs. And something that we're going to talk a little bit more throughout the conversation today.
Well, it does say, like in the old world when we were in free checking, it was, hey, we were making enough money off of interchange and overdraft and other things that we could sweep in a bunch of accounts and let them sort themselves out. And that game seems to be declining. A, there's fewer people in the market churning. B, we're seeing less of their wallet. And C, it's costing more to get them through the front door. And so those kind of three things are really challenging or pressing the economics for the decision internally in terms of that. Cool. This is one of the really surprising, as we process the data for the most recent study, is your customers are really polyamorous of other financial institutions. It used to be the wealthiest customers really drove multiple relationships, and the mass market tended to really consolidate the relationships into one or two banking relationships. And so there's been roughly a 4 or 5-fold increase in the number of consumers who have 4 or more financial relationships, which means the mass market is also using multiple institutions. How does this affect how you deliver services? I mean, I think a lot of us really think about getting the checking account as the core asset and then trying to expand from there. This is suggesting that model might be broken.
Absolutely. I mean, I think you got to rethink, but for me, it seemed like it's been broken for years, though, a little bit. I mean, I'm actually more surprised in the 7% than I am the 50. I've always had bankers tell me like, oh, we've got the whole relationship, we've got it all, and then they bring a little bit more to you, and they're like, okay, is that it? And they're like, no, yeah, that's it. And then again, now we're talking large sums of money they're bringing over. So I never really feel like we have it all. Like again, where I've been in my career, that's been consistent. Is they tell me we have it all, we don't. We have what they are showing us or what they think is relevant to us. Sometimes it's not even, the customer's not trying to, I think, have this, but they're like, oh no, that's where these funds are, and that's where these funds are. So they do have this segregated thinking. So we should rethink the segmentation too. So like, what's our segmentation around a multi-bank household? What does it look like? We think that we win, the primacy with, just by getting that checking account or something like that. It's not true anymore, right? They're going to have multiple accounts. So we just want a larger share of the wallet, and to be able to kind of identify, what part of that segmentation we want.
I mean, I think you bring up a really good point, is relevancy and consideration as you go through. And we've seen this, Mike, I think in some of the work that we've done together, is consumers are defining their relationship with you generally in the first 3 to 6 months. And if we haven't consolidated that relationship, one of two things is the case. Either they're early in their age wealth journey, meaning they just don't have any more to give us, and as they grow with us, we might get it, but that's an ongoing sale in terms of that, or vice versa. They've created a niche for themselves, is that I like this bank for doing these types of activities, paying my mortgage because I had an incentive to do so, but I like this other bank for credit card, and so on down the line. And so understanding that behavior starts to become important in terms of the calculus of acquisition. Is why am I acquiring this customer? What's my objective? I think that's really intentional. And Dan, you brought up another. Oh, go ahead.
one of the numbers that's not on the slide that shocked me is that 50% of customers, open an account but never fund it, right? So the ability to create a really seamless onboarding experience, and then messaging early and often to drive that activation is critical, because you're paying so much to acquire this customer. You want to make sure that you drive them to the revenue generating activities for the bank.
Well, and I think that's absolutely right as we go through. It's just the level of difficulty, but it's also the level of difficulty given the customer. And what Dan was hitting on, I thought was really interesting too, is that it's about primacies, not primacy. Is we used to measure primacy because the customer did 5 debit transaction and a deposit in terms of that. And that's really important in the mass market and probably up through mass affluent. But as we think about larger and larger wallets in the Henrys, that doesn't really describe their financial wallet and how they do. So primacy is a different definition around maybe only doing 3 transactions a month. One is paying off the credit card bill, the mortgage, and whatever else. So it's really kind of reimagining how we target customers and how we measure success.
Sure. And Henry, for those who haven't heard that name before, is high earners, not rich yet.
And it's not Henry Israel, by the way. That's why I had to use Hank as we go through. We really need to start talking about type as we go through. And in our latest research, we see that in the market each year, there's roughly 20 million consumers in the market for a new relationship as we go through. Roughly 60% of those are paycheck to paycheck. Roughly 30% are the stable mass market, where kind of think about suburban families as we go through. 5% are Henrys, and roughly 10% are mass affluent or above. And the interesting thing is that I think that when we think about this on a widget basis, in terms of acquisition, we're hyper focused on cost per acquisition or the like. What we generally end up doing is kind of focusing in on the left-hand side of this chart, because there's more of them in the market, and success gets measured by just the volume of acquisition as we go through. What we've come to learn is that the average mass affluent customer is worth about 22 paycheck to paycheck customers as we go through. And so if I get my share of the 9%, getting my share of the 58% matters less. So I don't have to move as much volume to get to the same value inside of our organization. But it does require a shift in thinking about how I attract and how I target those customers. Dan, you work in a relatively small institution. How do you guys think about like segment targeting and how you want to acquire these customers or meet them where they are?
I think we do have our mindset on, the more affluent customers, and I think it's right. But looking at this, this is, in my mind, the most important slide of the deck. Again, that 22 to 1 is staggering. So knowing that, I think we need a deeper dive and, mapping our existing clients base for these 4 segments, and, what's our opening mix over the last 12 to 18 months. And really quantify, what our actual drive is for our deposit growth. I think that's rethinking it a little bit. Again, I think our mindset is right, but again, just diving in and doing that analysis, I think really helps. And looking back and then, to project forward where we want to go, so that way we can make adjustments.
I think that makes a ton of sense. And what's interesting is there's no wrong answer here in terms of whether we're building the asset side of the balance sheet or the liability side of the balance sheet. I think what's important is thinking about what the strategy is and then defining the targets based on what we're trying to accomplish. We see a lot of institutions go out with a general marketing message, and the challenge is with other institutions, there's kind of some adverse selection. If I am not targeting those customers that I need in order to meet my objectives, somebody else is. So the average of what's left is probably going to be less valuable than if I'm more selective as we go. So just thinking about that as we go through it. Mike, anything that you'd add to this slide?
I think you both nailed it. Nothing to add.
Ditto is not an option in this relationship, Mike. Come on. as we go
I
through.
I guess just the one thing we see as we've done tens of campaigns on behalf of bankers is I think it's really important, and it's a difficult question to answer, is what is your objective, and what you need to have a single objective that you're trying to drive, typically within a single segment, and really anchoring on that so that you can drive an outcome versus trying to please everyone within every segment in a more broad-based offer that we typically fall flat.
I think that that's a really important message too, is that what we're seeing is that organizations that are more successful have a design target. They know that they are fishing for a particular type of customer, and they're aligning their targeting, their incentive, and their experience to what that customer wants. And this is really where, going back to that fintech growth, they're very successful at focusing in on their design target and bringing them through the experience as we go through. When we think about network banks that have to serve all of these segments, it becomes a little bit more challenging. It's multiple campaigns, it's multiple messages, and it may be different incentives to make things happen. And so it does require a little bit more work. It's, you know, the 201 class in marketing versus the 101 class when we have a single design target. Great point, Mike. As we move through this, we've also measured acquisition. As many of you know, Curinos sits on roughly 50% of consumer deposit accounts as a part of the work it does in analyzing and pricing industry deposits. And so we've looked at the decay curves of customers based on their initial funding as we move forward. And what we see is, not surprisingly, the more you get, the more they stay. They're more vested in your institution. So making sure that that funding experience is easy and we pull through is synonymous with how many of those customers you're going to be able to keep as we move forward. Mike,
I think
about,
two points there. Hank is a glass half full. I'm a glass half empty type of guy. I read this chart and look, oh my, this is great. The customers with more deposits are stickier. But if I look at, okay, how do I go and acquire those customers? It shows me that they're stickier. It's going to be harder to convert them and actually switch them. That's point number one. The second is, in some of the stuff we see in Curinos data and a lot of MasterCard's Finicity open banking data, is that folks are keeping accounts open, and I'm guilty of this myself, because the funding process to move as a W-2 earner, where my money is deposited from MasterCard into a bank, is very challenging, and without leveraging open finance capabilities. I need to write out a voided check, put it into intercompany mail, send it into the abyss, quite frankly, for a couple of months, and then at some point in time, my direct deposit is changed. There's been a lot of innovation in the mortgage space to make mortgage underwriting more efficient in the collective and moving of data. Likewise, in the deposit switching space, the ability to permission through a consented flow in your banking application to move that direct deposit, because we see a lot of folks sticking around and actually keeping two deposit accounts open, one where the money hits, and then typically a monthly outlay of that account to their primary checking account where they're managing their money.
the infamous switchboard account.
Exactly.
I think we've talked about this a lot, with the open banking as we've had conversations with you and just the different things that we're doing, because I think that is where you can improve, is just automate those steps. It's one thing to say get funding is definitely the message and get it quick, but how do you do that? You make sure it's an automated process. The other thing too, sometimes it's difficult to tell what portion of the share you're getting. So be careful, what your marketing or what your rewards are based on or incentives. Is it, $1,000 deposit? Because that could be an ACH, and sometimes these things all look the same. Do you want the direct deposit? But be very pointed about that. I like Mike's comment on the last slide too, about kind of just being pointed and drilled in, not only in the customer that you want, but the things that you want to influence for that customer. I think the more pointed you are, the better off you're going to be. I also like that he said he didn't have an opinion, then went on for a couple of minutes.
It wasn't a well-formed opinion yet.
Thanks for working it out with us, Mike, as we go through. This ties into the conversation that we've been having as well, is incentives matter. I can't tell you how many institutions ask me, expensive, or incentives are very, very, very expensive. When I look at it in relation to response rates, the amount of marketing that actually works, we're seeing, highly successful campaigns in very small amounts of customers getting up to 1%. So 99% of the digital outlay of all of that stuff isn't moving the needle. What we do see is probably up to a 30 or 20 to 30% improvement in response rates when we put an incentive, a well-designed incentive. And it's interesting as we go through, and I'd love your thoughts, Dan. What we're seeing is that, hey, the incentive isn't always paid out, but by having it, we're seeing greater throughput in terms of opening accounts, and it may not even be the right account, and the client may not fulfill all of the requirements to actually get the incentive, but it at least gets them engaged in consideration and conversion as we go through. What's been your experience?
I think it's definitely factual, but I'll reiterate the last two slides too. Still need to be more segmented, more strategic. Again, not only about who we're targeting, but then also what those things that we're incenting are. Again, is it, what do you want? Do you want that transactional? Do you want them to use the debit card? Do you want them to do this, or do you want them to do multiple things? And then also, how do you pull the trigger in the back? Are these manual processes, or how do you keep track of all these things too? Because you build incentive programs that are too labor intensive, for your back office may not be able to handle it. That's really tough. So do you have automation for that? Extremely important. But again, I think it's good to incent. Obviously, this clearly shows that, but not if you're not targeted, and not if you don't know what you're incenting for.
It reminds me of one of our early engagements where we were working with the customer, and we joined and asked them how their campaign performance was, and everyone's high-fiving, right? They had gone with a spray and pray approach. They made a $200 offer to pretty much everyone within the particular market and sent a piece of mail out, and they had opened up a bunch of accounts, and their cost per acquisition, actually, they were happy because that was going down. And we asked them, well, what are you trying to achieve here? And they were trying to drive deposits. And I'll pick on my family a little bit. There was a lot of very perverse self-selection in this particular spray and pray $200 offer. My brother never gets a $200 offer. He was in their market. He got it. He opened the account. There were no conditions on the offer. He put $57 because that's what he has as a teacher in his checking account, and never was going to become quality. So as those accounts seasoned and we start to look at the average funded rate and the average deposit rate, we realized you had acquired a bunch of accounts, but accounts that were never going to become quality and ultimately become profitable. So just kind of reiterating that, right? What are the right conditions? What are the right offer? And exactly being crystal clear on what we're trying to achieve and go after.
I think that makes a lot of sense. And I think that one of the challenges that we see in the industry is organizations see an $800 or $1,500 offer, and they're thinking, oh my God, I can't keep up with that. And the reality is that understanding what that institution's objective is to get to $1,500 or 50,000 Sapphire points or whatever it is, we're talking about relationships that are moving probably somewhere in the neighborhood of $100,000 or roughly $5,000 worth of economic value to the bank, and it pays out when we rightly design those things. When I'm acquiring an open active debit active account, the bait is probably in the $200 to $300 range. So it's understanding what's relevant for different customer segments as we go through. We've worked on some campaigns lately where the customer, for simplicity of the back office, wanted to go out with an offer based on a premium account that gave extra interest, but they wanted us to target debit card active customers. And so what we saw was, hey, this doesn't quite add up as we go through. We need to really kind of align those two outcomes so that we can be successful as we go. And then the incentives start to pay out. The other piece on incentives is making sure that they're economic for who we're targeting in terms of what is the lifetime CLV or the 3-year return on those customers, so that we're aligned with what their behavioral life is, so that it kind of pays out. You're never going to not be in the money, so to speak.
The last point there is they need to keep it simple, stupid, right? One, so the customer can understand them and feel that they can attain them. 2, so your sales, your front office can actually sell them and feels comfortable selling them. And 3, to Dan's point, operationally being able to fulfill that on the back end.
Super. That makes a ton of sense. And Mike, in traditional Curinos fashion, there's no point that we can't make more complicated as we go. And Dan, this comes to you as well, is we look at the efficiency or ease of a financial institution's online opening experience. On the left-hand side, you can see the data says, hey, more and more consumers want to open via mobile phone. On the right-hand side, what you're looking at is the journey effort score. So the higher the score, the harder it is for an institution to get through your experience as we go through. And when we look at between targeting, application, approval, and ultimately onboarding and funding, the difference can be as much as 6-fold for these experiences being difficult in terms of that. Which of those experiences are you struggling with, or which ones you think make the biggest difference in terms of conversion?
I mean, digital continues to dominate, so let's keep it there. We're investing in our omni-channel. We've made a big investment into our omni-channel. I mentioned earlier the open banking items that we're doing, and we've been kind of working through with Mike a little bit. I also mentioned I didn't really say what it was, but we went with MasterCard and did this Spark with them for on the marketing side and dove down into that too. So I think it's not just the channel itself too, but again, that start to finish, like how easy is it to get to those things? I think some people think like, okay, like, yeah, we've got our digital channel and we should be good there. And it seems pretty easy to us, but making sure get a second set of eyes on that because there's some good people out there that can give you some feedback on how to make it a little bit easier. And I think that's we want that effort. Look, we want it to be really easy to do business with you, or at least to open those accounts and start that journey.
Yeah, totally can kind of echo that. I think what some of the fintechs and some of the more innovative banks are laser focused on 2 things: cutting out the number of steps it takes. That could be a page click, right? For example, using a QR code on their direct mail to make sure that the digital experience opens up right to the account opening experience, and then focusing on minimizing the amount of information that's required of the user to provide them in order to be successful. So a lot of that is around identity verification, right? How can I get that information without them having to provide everything through consented access to bank former bank transaction data, to switching the funding source, to driving bill pay and switching where their bill pay is, and ultimately in the simplest way to activate their debit card and get usage out of that post account open.
Well, and it's interesting, right, is that there's a balance between ease and risk as we go through. One of the things that we've observed is as we've gotten more targeted in the consumers that we're trying to invite to apply for these relationships, we're actually seeing less fraud because we identified the consumer rather than the consumer identifying the financial institution. And it makes some of these other processes more redundant in terms of the risk that you guys are taking on in terms of what we've seen highest risk levels. And I think a lot of institutions saw this during the pandemic and just afterwards, where they tried to move fully online with acquisition, but their approval rates and or fraud rates kind of skyrocketed as we go through. So kind of balancing those 2 things seems kind of critical as you go through.
And this is going to seem like a no-brainer, but I got to say it. There's a very high correlation between high-quality deposit customers, as Hank mentioned, the risk of them becoming fraudulent, but also their credit worthiness, as a lot of the regionals and super regionals typically lead with a deposit product prior to extending credit. I'll pause there, but it's a kind of a duh statement.
Super. What we've been working on together as we look through is trying to leverage data to understand the consumers that we're targeting in kind of 4 dimensions as we go through to help financial institutions find the right customers. One question that we want to answer about a prospective client is, hey, are they really in the market right now for a new primary relationship, or is it a secondary relationship as we go through? The second question that we think is really important, and this goes to the relevancy, Dan, that you were talking about, is my brand relevant to this client? Like, am I selling uphill pushing rope, or is this client someone that will automatically know my brand based on where I am in the market, but also my awareness and the products that I have to serve as we go through? The next question that we want to understand is really around deposit quality. And what we think about deposit quality isn't what the customer is going to bring day one, which is how many organizations measure success in production, but how much of that deposit is remaining 6 months later or 12 months later as we go through post offer, post incentive, post payout, so that we're maintaining and targeting those customers that we're going to actually retain their balances. And the last sets of questions that we ask is really around transaction activity, in terms of, we kind of break it into two components. One is targeting those paycheck to paycheck customers or debit card active customers that will give us a lot of transactions, but they may not have the same cash flow as what we call payment active customers, people who tend to use their credit card but have higher overall input. What's exciting about these dimensions is, depending on how we mix and match them together, we can identify audiences, as Dan talked about, getting very specific about what we want to do. And we've all been in the position as deposit managers of having to fill in the deposit portfolio. And if I had to do it with this, I would kind of match my brand propensity with high quality deposits and find the customers that are most likely to come to me and bring me at least $10,000. And that would be one campaign or one targeted audience that I might go after. Dan, you might have an objective of, hey, I need to grow the number of households. I'm being incented in terms of the number of households. In terms of that, we don't judge the ones you love, by the way. We love them all in terms of that. But what we might do in that situation is really focus in on those debit card active customers and the brand propensity as we go through. In other situations, organizations are saying, I'm really interested in not speeding up acquisition that I might get over time because of just organically where my stores are. I'm more interested in incremental acquisition, where I can just get it at the margin, in which case we look at customers that maybe have a lower brand propensity score, but we make an offer that's slightly richer so that they'll consider your brand in terms of that. So you can see how incentive and targeting start to fit together. This is kind of like a new era. I mean, Dan, I think, Dan, Mike, and I, not to judge, but we've been around the block a few years in terms of that. When we first started out in banking, all customers were good customers, and that's certainly the case. We want to serve all, but we might want to attract more specifically. How does this look for you guys?
Well, first off, Hank, that's fair because everybody saw your picture on the welcome, so and then the difference. So, but I think that this kind of synthesizes earlier points pretty well. I think with just adding in that brand affinity point and what challenges that might bring, we're facing the same things right now of thinking through like our brand affinity, because we've got a really strong presence in Illinois, especially central Illinois, where we've got good market share and penetration. People know who we are, but we're in other larger markets, and again, I think it's just defining that strategy and how you want to go after those other segments, but it's not going to be based on that brand affinity, right? No one knows who you are. So what is it? Is it an attractive offer, or is it going after more of your corporate clients and their network? I think there's different strategies that you can have, but if you think you're going to come into a market, which I think this is some of what we're thinking, even like acquisition strategies, you're like, oh, we need to get in this market. Well, if you're a new bank there, or if that bank doesn't already have market share, then you don't have that brand affinity right away. So I think it's something that people need to think through carefully and differentiate their strategies based on that brand affinity within those markets.
Makes a ton of sense.
And I love this slide. And at the heart of this slide is the reason we partnered with Curinos. We realized that we need to optimize response rates, people that are switching and opening an account, and then the quality of the customer. average funded deposits per account. And with Curinos's data consortium ability to see 50% of the deposit data in the US, we've been able to prove out that their prospect scores continue to both increase response rates as well as ultimately increase average funded deposits. So it's at the heart of why we're talking about this together today.
And I think what's really exciting is that there's proven results as we go through this, is to really look at the markets that we're in and the like. And this gives an example of 4 different targeting strategies that we've executed with different institutions. One being just, I wouldn't say spray it. These were at least customers that had some brand affinity in terms of that. The debit active customers that we've been talking about, the payment active customers that we're talking about, and deposit quality. And what you can see is we're getting leftover control, but what's more interesting is we're getting response in the mass market where we have a ton of volume that we can go after, but you'll notice that the average deposits aren't that large. They're generally at roughly the average of the market. As we start to target for payment active, those debit or credit card active with bill pay and that sort of thing, and the deposit quality customers, while I have a lower response, the net value of that acquisition is actually higher than the general target or the debit active targets in terms of that. And this is before we lay on the ability to cross-sell into lending and credit card and all the other stuff. This is just looking at that deposit relationship as we go. And so it's thinking about, how do I trade this off? And this comes back, Dan, to your, the 1 for 22 slide, right? Is that you can kind of see it doesn't take too many of the deposit quality or payment active to offset some of these debit card active accounts. Thoughts, questions as we go through? Yep. Cool. We have 2 more slides as we go through. If there's questions from the audience, we'd happily just type them into the browser or the question chat, and we'll try to address them as we go. I think that if our audience is going to walk away with 3 key points, number 1 is acquisition is getting expensive, and it's getting worse over time. And it's getting worse because of competition in the market. More organizations are putting out more impressions. So in order to get to the same share of voice, you're having to spend more as we go through. There's also economies of scale. Larger institutions are able to buy more volume. And so as a result, smaller institutions are slightly at the disadvantage. So being kind of strategic about how you leverage those tools is really important. Number 2, not all relationships are equal. Yes, you can serve everybody in the community, but you might want to target very focused in terms of those that are going to drive the economics of the firm as we move forward. In terms of servicing the community and driving growth are 2 separate objectives as we go through. You need to obviously do both. One is an organic approach as we go through. And the last one is, hey, we need to choose carefully and thoughtfully. It's not that we're saying exclude people, but we're saying if I want to acquire a particular type of customer, let's identify that target and let's assign incentives to match what we're trying to accomplish. So as an example, hey, if you're going to bring $25,000, I'll bring out $500 in cash or whatever the magic incentive is that we go through. The final point, and we talked about this a lot, was the experience through the onboarding journey is reducing the opportunity cost of changing accounts. Mike talked about open finance and making it simple to move deposits as we go through moving bill pays, and also just that transition planning makes a huge difference. Not to mention the application process is minimizing the number of touch points that we have there. Anything, Dan or Mike, that you would add? There's one more slide that Mike's going to talk to.
Takeaways match cost, quality, friction. I think that's what we've been observing as well. To choose carefully, I just think we've been kind of repeating this throughout, but also, not only being very, very pointed, but go back and you got to make sure, did our selection happen the way we thought it would happen? Kind of reevaluating those. The costs are going up, so we know that cost, quality, and friction, right? So are you getting the right quality? Are you getting that choice that you wanted? reevaluate, refine before you push out the next effort that you're doing.
Oh, okay. So a couple other key takeaways from a MasterCard perspective, right? Making sure I think we Hank hit on a good amount of these, so we'll go through this quickly. Defining an objective, right? Managing that trade-off of, do I want to go into a net new market where I have less penetration and brand awareness, or into a penetrated market that there are going to be implications there on response rate based on your brand awareness, but balancing that strategic priority. I'll give you some. Curinos isn't going to share the true secret sauce, but I get to see a little bit from the outside with their models. The branch, I know there's a very heavy focus on the digital onboarding experience. The branch still matters, right? Typically targeting those folks that that are within, depending on if it's an urban or a suburban area, within X number of miles, 5 to 10, from where they live and where they work, typically drives increased response rates. With suburban areas or more rural areas, widening the circle. Ultimately focusing on a cost per value, right? So how much is it costing me to get $10,000 in deposits, and moving away from focusing on a cost per acquisition, right? And as you transition away from, a spray and pray to a more analytical approach, it allows you to create simple, compelling, deep offers with the right conditions to drive the right outcomes that you can ultimately communicate to your customers and drive impact. The third point here is really showing up the right channels, right? There's an interesting kind of battle between how do I manage the economies of scale, the economies of the channel that I'm going through, and the ability to cut through the noise, right? So if you have an existing customer relationship, so let's say you have a bunch of indirect lending customers and you want to cross-sell a deposit account, digital will probably make sense because you have their attention. You can send an email, it won't go to spam. You can activate them through your web app, through your mobile app, or through their billing statement at a lower cost than potentially sending out a net new piece of direct mail. However, most of the work that only cuts through that clutter, right, and gets the attention. Another insight is retargeting the right group of folks and potentially sending 2 pieces of mail over the right period of time does drive increased response rates and does bring in those quality deposits, because there is some negative bringing in as possible from an experience perspective to convert and activate quickly. We talked a lot about that, but then reinforcing that with an early month on books messaging to drive your customer for by going through the right simple gates through marketing messages, typically within the first 90 days of when you brought that customer on, because we were able to prove in our definition of a high quality customer is someone who has meaningful deposits, and those deposits are sticky. So they're still there 6 months after they've opened the account. And typically then you see a very de minimis impact on retention rates and attribution in the out years.
Mike, thanks for that. I don't know whether it was only me. You cut in and out, and actually we have a question related to marketing channel that I just want to hit. Are there specific marketing channels that we see in acquisition campaigns that are more successful than others, like email versus social media and the like? And I think successful is kind of an interesting phenomena as we go through there. We think that you have to think about top of funnel awareness, middle of funnel consideration, how are consumers perceiving your brand and what value you can deliver. And then the bottom of the funnel is conversion as we go through. When we think about acquisition campaigns, it's generally in that lower funnel spot. And what we see, and this was in Mike's comments, but I don't know whether everybody heard it, was direct mail is still king. Even though it's cheaper to do digital impressions, the response rates and the success rates are still not sufficient on a targeted basis to get the customers that you want. They're fine for kind of an average campaign in terms of, does that mean that we're saying don't use social? No, social could probably be middle of funnel, trying to demonstrate the value of what you're bringing to market and making people consider your brand as we go through. It's just that at the lower end of the funnel, we're still seeing DM kind of work pretty effectively. Any other questions as we go through?
Awesome. Hank, I was thinking about that one a little bit too. Just think about, like, it does kind of make sense if you think about it. You know, people were sick of junk mail for a while, but it's junk everywhere, right? Like, it is junk in your social media feed that you're like, oh, it's another advertisement, things like that. But then again, how effective is it too? How many people click on it? How many people share it? You know, what are people doing with it too? And again, I think if you have really strong penetration on those things, then I think you should probably up your efforts on it. I think if it's low, then it's probably not the best source for you.
And one of the things I love with working with Curinos is the ability to actually, from their marketing data, to see the number of pieces a prospect is getting within a particular market, so that you can figure out the right markets in the right time. I'll give another free piece of advice, which is very broad-based, but typically mailing between Thanksgiving and the Christmas holiday period of time. There's a lot of noise, not particularly from deposit acquisition perspective and bank acquisition, but just think of how much mail you get and how much you throw out and how busy you are during that period of time. So mailing at the right period of time in a consistent, almost quarterly basis typically drives the best results.
And I think it's the persistence of marketing too. We see organizations porpoise, they get into the market and then they get out of the market rather than having kind of a steady feed. We've seen a lot of efficiency in maintaining your presence over time, especially as marketing has taken over as a larger driver in acquisition. I want to thank both of you for your time today. Thank you to the audience for participating.
We got that one more. I had a thought around that one too, the branch channels being open. I think that it's, so the question, you mentioned that physical distribution channels have a decreasing role in acquisition, but branch closures have reversed course over the last couple of years. Can you share some thoughts around those trends that intersect ultimately their impact on acquisition? Yes, branches are increasing. They are putting presence in different places. I think there's a little bit of a difference there too. And it's not their job to sell the accounts. The accounts are walking in those branches. That's the thing. It is the marketing that drives them to the branch. So you're being strategic about their placement, and you're using the marketing to drive them in. You know, and I think there probably, if you have a really good sales team and things, I think there is maybe some influence there, but it's probably less than what you think. And again, this is just a guess, but my guess is you probably have about 10% influence in that location. Everything else is being driven by your marketing. Mike, sorry.
Oh, no. I mean, I think it's a good point. I think that when we say physical distribution channels aren't participating, this is in the decision of the consumer to pick your brand. Every consumer has, for the same functional requirements of an account, probably has 3 to 5 institutions within a 5-mile radius to solve all of their solutions. The branch impact in that is less important. I agree with Dan, is branches still have a part to play. They add billboard value, presence value in a market. So if you think about it as a persistent billboard that is able to transact, that's part of the marketing value of the branch. In terms of, we're talking about consideration as we go through. We do see branch openings going on. I still think the net trend is to the negative. I think that what we're seeing is national banks filling in their networks because they can no longer acquire in terms of that. So at least I live in Maine, not that you all couldn't guess that from the background, but you know, we're seeing presence of some national players kind of infill as we go. Mike, did you have anything else to add there? Or?
I guess there's a big push on digital, and I think when I think digital, I really think about just simplifying the customer experience. And folks are still going to sign up in the branch. I think investing, and Dan's probably got an opinion on this, in technology, so that as you have a co-piloted sign up in a digital experience, you make it as easy for the bankers to onboard your customers, leveraging some of the new technology that they could get in a more of a self-serve model for the folks that are going to continue to come to the branch and sign up for accounts.
Super. All right. I think that does it. The web or the materials from this presentation will be available on Curinos.com for your download as we go through, as would be a transcript of, or not a transcript, the video of it as we go. Thank you again, gentlemen, for your time. Thank you for all those in the audience for participating, and we look forward to talking to you.
Yeah, if you're interested in learning more about what we've done, or quite frankly, hearing the PG-13 version of this, because we were kind of put in a box in what we could and couldn't share, feel free to reach out to your account manager at Curinos, at MasterCard. We're eager to continue the conversation. Thank you.
Thanks, guys.